The core thesis here is simple, yet profoundly overlooked. The real secret to long-term investing success isn't about being a market guru or possessing some insider knowledge. It's about understanding the often ignored mathematical probabilities that underpin market performance. Let's be clear about one thing up front. The possibility certainly exists for someone somewhere to pick a single stock that absolutely skyrockets. We all hear those incredible stories of early investors in a company that became a giant. This narrative is undeniably compelling. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. In this video, we share a crucial conversation about building lasting wealth. Today, we're diving deep into an investment debate that echoes through every financial forum: index funds versus stock picking. This isn't just about choosing an investment vehicle. It's about understanding the fundamental approach to budgeting, saving, and investing. However, our focus today isn't on rare possibilities, but on predictable probabilities. The actual probability of you or any individual consistently outperforming the broader market through active stock picking is demonstrably not in your favor. This distinction is critical for long-term success. When we look at the historical data, a very clear picture emerges, consistently spanning decades. This isn't based on theories or speculation, it's based on indisputable market performance records. The numbers reveal a compelling and consistent trend. Long-term data overwhelmingly demonstrates that index funds consistently outperform the vast majority of actively managed funds. This isn't an occasional occurrence, it's a persistent pattern across diverse market conditions and time frames. The evidence truly speaks for itself. Active investing often comes with a variety of hidden costs, which subtly but significantly erode your potential returns. These aren't always immediately obvious, but they accumulate over time to create a substantial drag on your wealth creation. Understanding these costs is paramount. One of the most insidious costs comes in the form of fees. Active fund managers levy significant charges, often a percentage of your assets under management, which directly diminish the returns you earn on your investments. These fees compound negatively over decades. Frequent buying and selling, common in active strategies, also triggers capital gains taxes. Every time you sell a stock for a profit, a portion of that gain is owed to the tax authorities. This tax drag is a continuous drain on your investment growth. Beyond explicit fees and taxes, constantly trading stocks incurs transaction costs, such as brokerage commissions or bid-ask spreads. While seemingly small individually, these can add up significantly, especially with high portfolio turnover. These costs further reduce your net returns. Finally, we must consider the cost of emotional decision-making. Fear and greed are powerful forces that often lead investors to make detrimental choices, like buying high during a market frenzy or selling low during a panic. These emotionally driven actions are some of the most destructive costs to wealth. Here's where the math truly shines and clarifies the stark differences between investment strategies. The unparalleled power of compounding magnifies even the smallest advantages or disadvantages over extended periods. This exponential growth is key to building substantial wealth. A slight disadvantage, such as higher fees or missing out on key market rallies, can compound into a massive gap in your final returns over decades. Even a 1 or 2% difference in annual returns can translate into hundreds of thousands or even millions of dollars lost over a lifetime. This is the silent killer of wealth creation. Our perception of investing success is often heavily skewed by what's known as survivorship bias. We primarily hear thrilling stories about the rare, successful stock pickers who manage to beat the market with impressive gains. These narratives are exciting and inspirational. However, this bias ignores the thousands upon thousands of investors who tried, often diligently, and ultimately failed to achieve similar results. Focusing only on the winners creates a dangerously skewed perception of overall success rates in active stock picking. This illusion can be a significant pitfall for new investors. It's important to recognize that even highly experienced fund managers, armed with extensive resources, cutting-edge technology, and teams of analysts, struggle mightily to consistently beat the market. This isn't a lack of talent or effort. It speaks to the inherent difficulty of the task. The market, particularly in developed economies, is highly efficient. Information is disseminated rapidly and widely, meaning most publicly available data is quickly priced into stocks. This efficiency makes it incredibly challenging for anyone to gain a consistent, exploitable edge. Furthermore, the financial markets are characterized by fierce competition among these highly skilled professionals. For every buyer, there's a seller, and for every winner, there's often a loser. This intense competition makes consistent outperformance an exceptionally difficult feat. Market volatility, combined with the often futile attempts at market timing, significantly hurts active investors. The emotional roller coaster of trying to predict short-term price movements frequently leads to costly mistakes that undermine long-term growth. Trying to consistently buy low and sell high is notoriously challenging and, for the vast majority, ultimately unsuccessful. It requires perfect foresight not just once, but repeatedly across countless market cycles. This is an expectation that even seasoned professionals rarely meet. A particularly damaging mistake is missing even a few of the market's best-performing days. These days, often clustered around periods of high volatility, contribute disproportionately to overall market returns. Being out of the market during these crucial periods can severely impact your long-term wealth. While index funds may lack the thrill and excitement of picking individual stocks, they are statistically superior for the vast majority of investors. Their boring nature is precisely what makes them so powerfully effective for building long-term wealth. These funds provide broad market exposure, meaning you invest in hundreds or thousands of companies simultaneously, often mirroring a specific index like the S&P 500. This instant diversification significantly reduces company-specific risk, providing a smoother investment journey. Crucially, index funds typically have significantly lower fees compared to actively managed funds. Their passive nature means fewer analysts, less trading, and therefore lower operational costs, directly translating into more money staying in your pocket and compounding. Perhaps most importantly, index funds foster a disciplined approach by removing emotional decision-making from the investment process. You simply buy the market and hold, eliminating the temptation to react to daily headlines or irrational fears. This consistent strategy is a cornerstone of success. The key takeaway from this discussion is profound. Index investing isn't about being right or trying to predict the market's next move. It's about acknowledging the mathematical realities of investing and aligning your strategy with them. True wealth is built not through fleeting market predictions, but through consistency and the unwavering commitment to remaining invested over the long term. Patience and discipline are your most valuable assets, allowing the power of compounding to work its magic. Consistency, not prediction, is the bedrock of enduring financial success. By embracing a steady, disciplined approach, you avoid the pitfalls of speculation and position yourself to capture the market's long-term upward trajectory. This is how ordinary investors become extraordinarily wealthy. Ultimately, your financial future should be built on the bedrock of probabilities and sound mathematical principles. Avoid the allure of speculative possibilities and instead embrace a strategy proven by decades of data to be both effective and reliable. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning, so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further.